Hey everyone here, just a quick note before we dive into today's episode. Bell Curve is going to be taking a short summer break while the team recharges and enjoys some well-deserved time off. We've been on the air for 3 years, never missed an episode. Well, maybe a couple episodes, but we've never gone for a month off in the summer. So appreciate you all bearing with, and we'll miss you. And we're not going to leave you totally hanging because we're basically going to be having a highlight reel of some of the moments that you've loved. Consider it a best of Bell Curve over the last 3 years. So enjoy the highlights, and we will see you back in September. Quick shout out to today's sponsor, Katana. We'll hear more about Katana's 1 billion cat campaign later today. But for now, let's get into the episode. Hey everyone, quick disclaimer before we get into today's episode. Nothing said on Bell Curve is a recommendation to buy or sell securities or tokens. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely our opinions, not financial advice. Our guests and I may hold positions in the companies, funds, or projects discussed. The following clips are from our episode titled Hyperliquid's Bold Vision for DeFi. In this interview, we sat down with Jeff, co-founder of Hyperliquid, to discuss Hyperliquid's origins, their decision to build an L1, and the architecture behind Hyperliquid. We also discuss MEV mitigation, builder-deployed perps, and balancing vertical integration with ecosystem growth. Enjoy. You know what I found myself wondering, when we're describing this, and maybe to just, again, rewind and summarize sort of the history of Hyperliquid, which is you guys kind of started as a perp dex by a bridge to via Arbitrum, right? Like kind of that's originally how a bunch of the assets flowed into Hyperliquid. And now you've built your own sort of instantiation of the EVM and are a bona fide L1, right? And, I'm curious when I think about what you guys are experimenting with, a lot of other protocols, especially on Ethereum, might have thought about building an L2, right? And when I look at, what like Monad is trying to do today, or Base, they're all kind of experimenting around what changes they can make to the EVM, because that's kind of the bottleneck for throughput at this point. But they've chosen to build this in L2 with a centralized sequencer. You guys have gone in another direction and are innovating and experimenting with your own sort of souped up version of the EVM, but you also want to build as an L1. So talk to me about that design decision. Why L1 versus like an ETH L2?
Yeah, Monad is an L1 too. So I think the examples you give, maybe like the common thread is that they're like vanilla EVM execution as opposed to sort of expanding the sort of execution logic. Would that be a fair summary of the question?
Yeah, that's a fair summary. I mean, I think this is also a challenge of the L2s in general as well, is like the backward compatibility, which is obviously that you want to kind of build on this, ecosystem of developers who are used to building in the EVM, but also you want to make some changes so you can increase performance because there are some real limitations around the EVM. So,
yeah,
I'm curious.
It's a good question. I think. Yeah, there are many sides. There are many answers to this. Like one of them is a practical one, which is just that initially the priority was just to get something that users wanted at all, and the easiest way was to not worry about an EVM. But yeah, I think at this point we have the luxury to kind of like zoom out a bit and say like what is the correct thing to do, given that all of finance sort of should happen on one platform. And I think even sort of retrospectively, if we could have changed anything, I don't think I would have. I think the EVM is great. I think it's really good for, like, maybe a good analogy, I think, is like the EVM is to like all of finance as AMMs are to like all of trading. So it's really good to cover this like super long tail. And I think people underestimate like just how long the tail is of like things that can be done in finance. And this is where like AMMs cover super long tail liquidity, where like if there are only like 5 people in the world who want to trade some asset, like an AMM is like probably the best way to sort of coordinate that trading. So I don't think it's good or bad. It just like has its use cases. And I think if you want a platform that can house all of finance, it cannot just be built on an EVM, no matter how performant the EVM is. And then maybe like one example, which we kind of gave, we gave this example like way back, just when we were like even starting Hyperliquid, because there were a bunch of questions like, oh, why isn't it just built on an EVM? And the example is just like if you have a perp dex, and with perp dex, it's just the number one concern is risk for the system. And the Hyperliquid I can like write down these like, just like mathematically prove to you that like Hyperliquid is solvent. Like every perps market is solvent at every block. And of course, there can be bugs in implementation, et cetera. But I mean, like, theoretically, there's no way for the system to have bad debt, assuming you implemented everything correctly. And but I would not be able to do this for an EVM based perp dex because there's no execution guarantees. Like you can never with an EVM, there's always some sort of like auction system or otherwise to determine which transactions go through. Whereas on a custom execution environment, you can say, well, like when this block happens, like we need to do these things to make sure that the perp balances like kind of are all positive, or whatever condition you want, like positive within some bound or whatever. Like you can basically say like this logic needs to execute on every block, no matter what users are submitting. I think that's like super important for derivatives. So yeah, I think like long tail spot trading, no need. If it ain't broke, don't fix it. But yeah, when the ambitions are bigger, I think you kind of need to look beyond and kind of you have to question everything and say like, is this really the best way to do things?
One theme that we're very interested in this season is this idea of vertical integration. And when you look at a lot of the dexes in Ethereum or in crypto today, you're starting to see a little bit of that, right? Which is like Uniswap is a really good example of a protocol that started at the AMM layer, and they're kind of going up and down the stack, right, towards the distribution layer of having their own, UI, like desktop UI, and then their own wallet, and then down the stack to their own chain. You can look at like the recent competition between Pump Fun and Radium in Solana as another good example. Jupiter is the same thing. And so, I think especially like UI is super, super critical when it comes to exchanges, which is maybe what is the sort of driving force here. But, I'm curious on your thoughts in general on the idea of vertical integration when it comes to DEXs, whether or not, how Hyperliquid thinks about that, what areas of the stack are the most important for you to have direct control over. And then, you mentioned at the beginning of this episode that, or actually I heard you in, a 0x research episode that I was listening to before this, there's so many things that you need to get right. You need to design the right environment for traders, for market makers, but you also have to get the UI stuff right, which has been a real challenge in the perp space so far, obviously until, you guys have done a really good job on moving the ball forward there. But talk to me about how you think about vertical integration in general, and then UI, right? Like what is important to get right from a trader's perspective here?
Yeah. I think vertical integration is obviously super good as like a business decision. Like if you're just like a traditional company, you want to own as much of the stack as possible. I think it's like part of that is just like it's often unclear where the value accrues, but another part of that is just reducing the overhead of like if you have like many people you need to rely on to uphold their part of the deal, then your ultimate user experience is only as good as the weakest link in that chain. So, and I think that's also true in crypto, but I think there's a bit more tension in crypto, which is that sort of owning the full stack is also a bit antithetical to, I think, what DeFi should be. Like I think DeFi is more resilient if there are multiple possible choices at each layer of the stack. And so if any one of them is compromised or just goes down or like whatever, like loses, it starts going in the wrong direction and like stops prioritizing the right things, that like ultimately you can find some path through these so like different options at each step. You can like find some path that's like still pretty good. I think that like creates a much more robust financial system. So it kind of depends what you're optimizing for. From Hyperliquid's perspective, I don't think it's like a huge. Basically, like we never even seriously entertained the idea of building everything in finance, and so I think when the vision is that big, it's necessarily built by many people, and I'm very bullish personally on like coordination through protocols, not through like management. It's like you have like a 10,000 person company, you probably build all the finance, if like everyone's super good and coordinated and whatever. But like I just feel like I just don't see that happening in the real world. And so like the next best thing is like 10,000 people coordinating across 1,000 companies, like each building their own pieces and like in a thoughtfully designed protocol to coordinate those efforts. And I think that's where I see Hyperliquid. being. And I think it's just like the end state is so massively impactful, and just like there's just like so it's just like such a valuable enterprise as a whole, like finance, that I don't think it matters if like Hyperliquid doesn't need to capture all of it. It's just that's like a super greedy perspective. I think. I think if you're like I'm doing this like one super small segment, then yeah, maybe you actually care about squeezing out every last bit of profit for your shareholders or whatever. But when you're building a protocol to power all the finance, I think the perspective is more like it's just like let's just like grow the pie. And if this thing is to succeed, like everyone's going to be like so happy that it doesn't matter.
There's maybe one area of like sort of vertical integration that we've seen across a lot of exchanges that I'd be curious for your take on, which is we've seen a lot of like centralized exchanges try to capture some of the economics from the stablecoin balances that are held on exchange. So Coinbase has this very lucrative distribution agreement with Circle where they get a lot of the carry. Binance several different times has tried to either partner or kind of like white label their own stablecoin to capture some of that huge amount of like yield that's just latently being generated on all the stables that are on their exchange. And I think that's a really interesting angle because it's taking money that's completely outside of, it's not like taking from builders or users, it's just taking money from basically the US government and injecting it into your ecosystem. So I'm curious if like Hyperliquid has any, if you have any thoughts about, how to capture some of this economic juice from all the USDC on chain on Hyperliquid, whether that's, agreements with Circle or with Coinbase, or, maybe even having another kind of white labeled stablecoin or something like that.
Yeah, it's not currently something we're working on. I think your question sort of highlights the point that there's just so much low-hanging fruit that like it's kind of hard to believe, but there are like billions of dollars like of stables sitting on Hyperliquid, but up until now the priority has not been that has actually not been the low-hanging fruit. Like that's maybe like more than $100 million of yield at this point, but also the protocol makes annualized like about like 5 to 10x that. I don't know the exact details, like not enough data points exactly to extrapolate a year, but I think you get my point, which is like there's just like so many things to do. And I think it'd be cool eventually for the protocol / users to be able to have all sorts of benefits, right? And I think this is what happens when all of finance moves onto one chain, is you get to kind of if that chain is designed thoughtfully and not greedily, like not as a sort of company maximizing extraction, but rather a company maximizing just cool shit that can be done, then I think all this stuff becomes possible.
This episode is sponsored by Katana. Katana is a DeFi-first chain built for deep liquidity and real yield by redirecting chain revenue back to active DeFi users. The 1 billion KAT campaign is live. Bridge and deposit directly into vaults in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. We're entering crypto's cloud era, and EigenLayer just launched EigenCloud to power it. Just like AWS transformed the internet, EigenCloud is a full developer platform that gives developers cloud-grade programmability with crypto-grade verifiability on any chain. To learn more about how the Eigen token is securing a new class of verifiable apps and how to get exposure to this growing class of crypto infrastructure, follow them on X at EigenLayer. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. The following clip is from our episode titled How Bitcoin Prepared Us for the Memecoin Era. In this interview, we sat down with Murad to bridge the gap between Bitcoin maximalism and meme coins. We dove into the exponential growth of altcoin bubbles, parallels between NFTs and meme coins, and finding cult-like communities. Additionally, we asked ourselves, how important is revenue? Is Bitcoin a meme coin? Can older altcoins ever come back? Finally, we unpacked the 4-year crypto cycle. Enjoy. So help me like connect these two versions of yourself, because one, you've got Murad, the Bitcoin maximalist, and most of the Bitcoin maximalists that I know or follow don't really look too kindly on meme coins, right? They have a very disparaging sort of view of it, or anything that isn't necessarily Bitcoin. It's a a distraction at best, and kind of there's obviously a worse way of looking at it as well. So walk us through, how did you get from, like, help us bridge the gap there in between these two sides of you.
Yeah, for sure. So first of all, we need to understand that your opinions as a trader, and then your opinions as kind of a long-term investor, and then your opinions as sort of like a monetary guy, and your opinions like from an ideology perspective, like those can all be completely different, right? So depending on the angle from which you view the situation, your opinion would be different. I actually, as crazy as it sounds, think that sort of the thousands of blogs and books and all of that Bitcoin maximalist literature was kind of like perfect preparation to understand meme coins. And the reason for that is can be concisely explained with horseshoe theory, which I'm sure you've heard about before. The sense being that a lot of people look at many different things, but for example, the kind of political spectrum as a line, where the far right and far left, for example, are the polar opposites, right? But a lot of people have noted the extreme similarities between the two, and really they are much more similar than they are different, right?
Yeah.
I think that the meme coin super cycle, which is currently, in my opinion, underway or in the early stages of it, are obviously a byproduct of kind of like the VC token industrial complex that exists in crypto, which itself is a byproduct of kind of like the fiat monetary system, right? So meme coins existing, they kind of arise emergently because of outside forces, right? And if you study sort of a dozen or so trends inside the crypto industry and combine them with a dozen or so trends that are kind of happening in the world at large, the fact that something like this is happening starts to be seen as less crazy, right? But Bitcoin is a money, right? But meme coins, they are not a money. Some people think of them as social currencies. I don't believe they are. They are something different altogether. And however, there are many things which Bitcoin and meme coins share, at least the best ones. And that is sort of their extreme cultiness, right? Their extreme, almost like a neo-religious type zeal that their holders embody. And from that particular perspective, there are a ton of similarities, right? I don't want to kind of run ahead of myself, but definitely happy to dig deeper into that topic, kind of in the coming minutes.
Yeah. Okay. So there's a ton that I want to dig in there with you. So I love the horseshoe theory. I actually just finished watching Peaky Blinders. There's a great speech. I don't know if you've ever seen that show, but it's a great speech that the protagonist gives about, he's referring to fascism and socialism. And he's like, you go far enough on the right and the left and you meet. And then there's just me in the middle trying to have an honest business. I was like, damn, I bet a lot of people feel like that at the current moment.
Yep.
But here's a way that I would connect Bitcoin and meme coins, is that there's the same underlying catalyst and driver. And the same underlying catalyst and driver is this structural issue with the credit-based fiat system that we all have, right? The money is breaking. And so there are a couple of, on the one hand, what that should do is push people towards a much more fundamentally sound alternative, right? Which is Bitcoin. The other thing that a breaking fiat currency system does is push people towards speculation, right? And this happens during periods of inflation as well. Just, hey, my money's depreciating and there's no way to get ahead, so I might as well take these really super risky behaviors and just gamble, right? And so there's the same underlying cause, but it manifests itself in very different ways. And so on the one hand, if you're bullish on Bitcoin, the irony is you should probably be really bullish on things like meme coins, and maybe previously this was NFTs and things like that. Is that roughly the way that you see them, or I don't know? What's your thought on that?
Yeah, I mean, I'm pretty much aligned with what you just described. It pretty much boils down to empathizing with retail, because if this particular cycle that we are in is anywhere even remotely similar to the past 2 or 3 cycles in crypto, then we need to understand that kind of like the altcoin complex that exists, the VC business model that exists in crypto, um, and the parabolas that often occur in kind of year 4 of these cycles, none of these can exist without a sudden influx of retail, right? And
Yeah.
if you kind of microeconomically put yourself in the shoes of a retail person, they probably understand that, again, if they kind of like mirror think and they sort of anticipate some kind of a parabola in 2025, they know that the 3x or whatever that Bitcoin still might have in it is not going to sort of change their life, so to speak, right?
Mm-hmm.
And of course, Bitcoin is sound money, and I expect it to eventually become the global monetary reserve. However, it is going to take time. This is probably a 15 to 25-year affair in general, right? And so, because this inflation and this sort of expansion in global money supply pushes people further down the risk curve, right? We need to understand, for example, if we look at 2016, 2017, that was the cycle of kind of Ethereum, ICOs, and altcoins, right? 4 years later, 2021, we had DeFi, GameFi, NFTs, and like a lot of like Ponzi or Ponzinomic like experiments, as well as some like metaverse stuff like in late 2021, right?
Yeah.
Now, the way I see it is the rapidly growing money supply around the world is mentally affecting kind of people's mental health, and also possibly even people's hormones, like at a molecular level. A lot of like, not many people make a connection between like fiat money and mental health, but Bitcoiners talk about that a lot. And they've been talking about this since like 2014. And this is why I jokingly say that all of the Bitcoin maxi literature was kind of perfect preparation for this, because I jokingly say that we will probably see Weimar before we see La Belle Epoque, right? And so essentially, I think that we will see hyper meme coinization before we see hyper Bitcoinization, right? And uh, it is logical in my mind that the core altcoin narrative of each cycle needs to become quote unquote crazier, right? And even beyond crypto, if you look at financial bubbles and technological bubbles, the asset class or the asset category that particularly lends itself well to parabolas or bubble like formation, it's things that are difficult to value. It's things that people don't really have a clear framework or a clear consensus as to how to price them. And from this particular perspective, I think the fact that meme coins don't have any revenue, and in fact, they take this a level further and they don't even offer a technological product or any sort of software or a platform, it's actually a huge advantage. It's actually a gigantic advantage, in fact, because and I know this sounds like weird and almost sort of paradoxical, but if there's no clear metrics other than price itself and a few derivatives of price, then it is a perfect product for these sort of parabolic type moves to occur. And again, as I'm saying this, you please differentiate between me, sort of the multi-decade predictor, and me, the sort of like the 2 years out person who's trying to find like the biggest category outperformers, right? Because these are two separate jobs.
Shout out to today's sponsor, Katana. Katana is a DeFi-first chain built for deep liquidity and high yield. No empty emissions, just real yield and sequencer fees routed back to DeFi users. Incubated by Polygon Labs and GSR, Katana is launching with notable ecosystem of primitives, assets, and partners like Morpho, Chainlink, and more. Katana's 1 billion KAT campaign is live. Bridge and deposit directly into Vault in one simple click and start earning immediately on your Ether, Bitcoin, USDC, and more. Follow the link in today's show notes to get started. EigenLayer is ushering in crypto's cloud era with the launch of EigenCloud. EigenCloud is a full developer platform that gives developers cloud-grade programmability with crypto-grade verifiability on any chain. EigenCloud's use cases don't stop at crypto. AI's rapid growth is reshaping how we live, work, and connect, which has simultaneously made it today's most important and least trustworthy technology. EigenCloud has arrived just in time to enable verifiable AI infrastructure with crypto economic guarantees, where incorrect behavior gets financially slashed. This isn't about picking winning apps or chains. With Eigen, stakers can own the fundamental building blocks of the verifiable cloud. Every application built on EigenCloud draws security from staked Eigen tokens. Every crypto economic guarantee is backstopped by slashable staked Eigen. To learn more about how the Eigen token is securing a new class of verifiable apps and how to get exposure to this growing class of crypto infrastructure, follow them on X at EigenLayer. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research. The following clip is from our episode titled Everything You Need to Know About Crypto Treasury Companies. In this episode, we were joined by Jeff Park to explore the financial engineering behind Bitcoin treasury companies, convertible debt, preferred equity, and the sustainability of these treasury vehicles.
It would be helpful to kind of just like go through not like the entire history of Saylor, but he starts with this kind of dead software company. I'm assuming he does kind of like at the market issuance of equity. He gets bigger and bigger, and then he eventually taps the convertible debt market. Like maybe just like a little bit of his path. And then, I guess one question that I had at least is, when are you big enough to actually tap the convertible debt market? And maybe like some commentary around how that was initially received and how it's evolved would be great.
Yeah, great question. I think there's like levels to how you get your equity to be valuable beyond the price action, which is that you have to build like an ecosystem of liquidity and a thriving options chain and a variety of like multiplayer dynamics to bring some energy to the stock beyond like just being valuable from a market cap perspective. And so that takes time. I think that's why Saylor, for the most part, is the leader in the space, because he's been around the longest to create some of that durable moat for the liquidity provisioning that has been very hard to replicate without that first mover advantage. And also to the context of the credit market, today, we take for granted that most, and actually all of Saylor's convertible debt are issued at 0% coupon from a cash interest perspective, but that's not true from its history. In its original history, when it first tapped the credit market, they were cash paid interest rates. In fact, he used to have this subsidiary called MacroStrategy as part of the entity that would hold Bitcoin. And it was not actually part of MicroStrategy, and it was ring fenced. That's all changed, of course, in the way that MicroStrategy has grown up to fully become a Bitcoin native treasury operation and company. But you're asking the right questions, Vance, as to like how do these evolutions happen, and at what are the kind of parameters in which these things are permitted. I think for the credit market in particular, there's a certain size for issuances that makes it meaningful for institutional investors. And from my experience of having been a credit investor before joining Bitwise, the difference between 250 as an issuance and above is a pretty material level from a threshold perspective. And if you want to imagine issuing 250 million or so, where the debt to equity ratio is manageable for what is otherwise a Bitcoin operation, you'd have to imagine the market cap has to grow to a certain level for that to be permissible. And to date, I think strategy has generally wanted that debt leverage to be very low, right? Somewhere in the 10% range, maybe a little bit higher, but really not your typical debt to equity ratio of like most corporates that access the credit market. Some of it, I think, is endogenously driven by Saylor not wanting to overextend, but I would also imagine the other side is that the convert market too doesn't want to actually tap into a leverage profile where they would actually be at risk. And you want to account for the volatility of Bitcoin's historic drawdown to 80%, for which some of that debt to equity ratio can be informed. I think the amazing thing is, nonetheless, Sailor has been able to retire those old legacy issuances and has now fully transformed into tapping the convert markets to his advantage with 0% cash interest rate. And that has actually ventured into a new frontier by accessing what historically has been a very, very boring, what I call like the armpit of corporate securities, the preferred market. And is trying to make it into a much more vibrant ecosystem through now I think he has over 4 different types of pref equity instruments since the beginning of this year. And that has never been done before. Pref equity is generally not accessed by retail investors. They don't have a shelf registration. They don't have tickers. And we have to give Sailor some credit for bringing upon an era of new financialization where pref equity is becoming cool again, sexy again, with retail investors finding that to be a worthwhile endeavor.
Just one last question. So he starts with like these ATMs. He's like selling just like normal shares, as he's kind of in whatever year he started buying Bitcoin at like 13,000, and then he does the converts after he's like big enough, and now he's kind of gone back to equity, but it's like differently constructed versions of equity that kind of look a little bit like debt. Is that right?
Yeah, that's right. That's right. So I think what Saylor unlocked, either intentionally or unintentionally, is that convert investors have a very different motivation to playing the game. And some of it is that the entire business of convertible arbitrage is founded upon extracting value from very high volatility that can be mispriced. And because MicroStrategy is such a volatile stock based upon, of course, its holdings of Bitcoin itself being very volatile, he was able to give convert investors a kind of an absolute yield that historically is not possible without very high undue volatility. Usually, when the undue volatility is as high, it's because the company is at default risk. And so, as a lender, you almost never want to touch it. But here, the reflexive thing being if the volatility is coming from pristine collateral, which in itself is the collateral for lenders to feel comfort around, you get the best of both worlds. You get high volatility, but you also get this asset-backed credit-like profile and having collateral for liquidation. So very unique phenomenon. He taps into it and then quickly finds out that this alignment is actually really good for equity, which is that converts are happy to uh, become equity at a much higher price, hence having coined the term accretive dilution around this construct, for which they are able to give equity investors an equally worthwhile push for the monetization of its volatility. At the same time, I think what sailors realized is there are sometimes adversarial market dynamics that can arise out of these participants. So for example, let's say you're a convert investor, right? That means you're basically long a call option on MicroStrategy that is way out of the money. And if you were to basically hedge that exposure every day from a market neutral perspective of monetizing that gamma, you're essentially going to go out and create dynamics that lead to mean reversion in the stock price. So meaning, let's say I'm long this call option and stock price goes up a lot. So my delta gets really high. Let's say my delta went from 10 delta to 30 delta with a gamma. So now I'm really long the stock. You as a convert manager, you have to go sell the stock now to flatten that risk out. So what that means is as the stock price goes up, you're counteracting that dynamic by selling stock into the market, therefore reducing its upward momentum. And the effect is the same the other way around. If the stock goes down and your delta is going down, you as the convert manager have to buy back the stock. This is called long gamma hedging. And long gamma hedging historically mutes volatility. And so once you become big enough, that trading activity in itself can be a volatility impediment. And that I think is what Saylor has also realized. If you make convert investors too big of your market participants, they can also mute volatility, which is the exact opposite of the outcome you want to achieve. And so there is a delicate balance at how much convert investors you want in the ecosystem, thriving alongside other investors in the pool.
Following clip is from our episode titled Entering Ethereum's New Era. In this episode, we discuss Ethereum's evolving culture and product focus. We also dive into Ethereum's DeFi and RWA dominance, scaling the L1, real-time proving breakthroughs, and Ethereum's long-term vision. Enjoy. It seems like Ethereum is really running away with the DeFi market and the RWA sort of tokenization market. And, Tomas, I'd be curious to get your perspective on this, because yeah, it seems like, and actually it seems like and this is why I think there's so much debate about REV in general, is just because if you're, I guess it depends on, like, obviously certain chains are set up to do better on certain metrics, right? And so whenever a metric gets created, the chain that, looks good based on that metric, champions it, and the other chains push back, and it always
Define your
ends
own
up.
KPIs.
Yeah, exactly. Whereas in reality, I think there's a lot. We haven't actually defined what REV is, so I can circle back to that at the end. But I would be curious, Tomas, if you think, and I'm curious, why do you guys think it's been so sticky with DeFi on Ethereum? And similarly, it kind of seems like Solana is running away with consumer in general. But I'm curious if you see these use cases being sticky to one chain or another, and why do you think it's DeFi that seems to be taking off on Ethereum versus maybe consumer over on Solana?
Yeah, sure. I mean, like, there's definitely aspect of the pre-existing liquidity and all the components of DeFi that are there that you can later compose and take advantage of larger finance, larger users to be there and creating liquidity space and fee generation. Now, yes, as you say, like when you have consumers, when you have the gambling aspects, the meme coins, and so on, so definitely you've seen it much more on Solana in the last year or so. And it's not that we don't want to see it on Ethereum. We absolutely do want to see it in Ethereum. And Ethereum was going through that scaling roadmap of saying, let's see L2 scaling massively that activity. And then towards the end of last year, we felt like, oh wow, yeah, we're there. Like it's scaled, it's available, and I think we arrived maybe just like a few months too late for some of those applications and projects to launch on the L2s when they were getting ready. But I think that now we are ready to take it back, and then as we progressing towards the integration of all the layers together, all the L2s, then you should see the network effect, and those applications should be very comfortable coming back to launch on L2s and say, yeah, like we can run it at the same speed. But yeah, it will be challenged to look at, are there some UX on-ramp components? Are there already some users of this new wave that just stay on Solana and feel very comfortable there, and how you attract them to Ethereum space? So this will be for sure an effort, but also we see a lot of signals that many applications are ready to launch on L2s, are launching on L2s on Ethereum, and it's not like suddenly everything escaped. And there'll be many builders feeling like, okay, this was the innovation, how I can evolve on this, how I can experiment with it also on Ethereum. And many of the like old builders or G from Ethereum are coming back and I say, oh, actually this is a fresh moment. This is the crisis, the battle. I want to come back and I have lots of ideas I want to launch. And what we receive as an ask is to build this spaces, communities, super team-like structures where we support new builders, new founders on Ethereum to launch applications. So this has to happen, and it requires some effort, coordination between different institutions, L2s and One, Ethereum Foundation, incubators, accelerators. We're welcoming them now a lot to Ethereum to collaborate with Ethereum Foundation and accelerating these pipelines to just say, hey, we are ready, and we were asleep for a while, and sorry for that, and let's build it. There is lots of excitement. We run the events where lots of new builders, lots of new fresh blood is coming to the ecosystem, and we will be building with hardware, with AI, and we very much welcome all the like trading or gambling experiments. It was fun, and like so many builders from Ethereum that now are super serious. We're starting with absolutely silly ideas years ago.